we've got some downside here to roughly around 5,900-ish. Would be reasonable at that point. As we kind of get down 5,850, 5,900, you're going to be coming up on the 200-day moving average. That's probably going to be your next entry point to add exposure to your portfolio. We're getting a lot of stuff set up here. If we can just get this market to cool off here just a bit, give us a bit of a pullback, would be even better. But even just a continued consolidation here is just fine. Work off some of this overbought condition, then we can definitely get some more money put into the markets and increase our equity exposure.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap with my good friend, the Lifecycles portfolio manager, Lance Roberts. Lance, how you doing?
I have not had lice since I was a kid. Actually, I've never had lice. My kids had lice growing up. They would get it from school regularly, but me never. So,
we had the same deal too. I never had it growing up. But for whatever reason, especially if you have girls,
yeah.
sleepovers is just terrible for that when they're young, right?
No, and then I haven't really thought about that, but that's a true statement. My boys, so I have 4 kids, right? So I have 2 boys, 2 girls. And it seemed like we were constantly fighting with the girls when they were in elementary school and intermediate school. It stopped once they got into high school. But when they were in elementary and intermediate school, it seemed like we had lice like every 2 weeks coming home from school.
Yeah, well, for ours, it was always sleepovers,
Yeah.
right? When they have the longer hair in general,
Yeah.
but then they like to kind of, huddle up with their friends when they're having sleepovers and stuff, and
Yeah.
it's just a transmission factory. Anyways, probably not what people wanted to hear us talk about. By the way, lysum has nothing to do with lice. It means supple and relaxed. And you had turned 60 not that long ago,
Yep.
and the Thoughtful Money crowd got you and your wife some massage
Yep.
gift certificates. I hope you've used them by now, Lance.
We have not had a chance to use it.
Bad husband.
They're going to get used. I absolutely promise you that. But this past month and really month and a half has been just graduation parties and trips to Baylor for, getting my daughter set up for college. It's just been every weekend has just been booked lately. So not supple, not relaxed at this point at all. And hopefully after the end of this month, things will calm down a bit and we'll have time to get those done.
All right. Yeah. Well,
But absolutely, and most importantly, thank y'all very much for those. It was a very nice gift. It will not go to waste. I absolutely promise you.
okay, good. Yeah, because after a busy couple of weeks like that, sounds like what you guys need is a relaxing massage.
It just seems like I could never get a weekend off. So it's just like always something.
All right. Well, look, well, first, you are, I think, going to get a week off in the
Yes.
not too distant future. You are going to the UK. Last week, you talked about hoping to get a table at Clarkson's pub or whatever that's tied to
Yeah.
his farm. It sounds like you guys were able to land that.
Yeah, we got a reservation, and so that's going to be our next to last day in London. So, my son lives about 3 hours outside of London. He lives in a little town called Sleaford, which is just outside of Lincoln. So, if you're listening and you're in the UK, it's funny. I ask people in the UK all the time. I was like, "Hey, do you know where Sleaford is?" They're like, "Have no idea," because it's this little hamlet out kind of in the middle of nowhere, but it's outside of Lincoln. So we'll fly into London, take a train to Lincoln, meet our son. Then it's about an hour and a half drive from where we're going to be in Cotswold over to this particular restaurant. So we're going to rent a car and drive on the wrong side of the road just to make people mad. So,
All right. Well, I look forward to hearing your stories. And
oh yeah,
like I said, if you see the man, see if we can't land him for a interview here. And maybe if we do, we'll try to pull in Joel Salatin. Folks really loved that concept when
yeah,
we talked about it last week. So if we can make it happen, great. I don't know what's in the air, but I think, as I mentioned too, I'm headed over to Ireland about a month after your trip.
yep,
It's going to be real quick. My daughter's going to be studying in Europe this summer. She's studying design at college here in the States, but there's a special design program she's doing this summer. So I'll meet up with her right as it ends. And so anyways, if anybody's listening here who's either lives in Ireland or is knowledgeable about Ireland, we only have a couple days. We're probably going to stick in the Southwest. If you have any ideas of things, must-dos while we're there, let me know in the comment section. I'll be totally interested and appreciative to hear them. All right. Well, look, we got to get on to bigger and better things here, talking about the markets. Real quick, though, just on these little intro words, I'm getting a lot of feedback from folks that they like this cute little introduce Lance with a new word every week. And I just got to let you know, folks, it's not easy. After we, I mean, Lance, you and I have been doing this for what, 3+ years?
Yeah.
My thesaurus is running out of words, but we'll keep it going. And at least this week, it's Lysum. Who knows what's going to happen next week?
Well, yeah,
Maybe
the good thing is after 3 years, everybody has such a short attention span now. You can just start reusing words from
start
like
re
3 years ago, and they'll never know.
Who knows? Maybe. Hey, speaking about short attention spans, we were talking about uh, short form versus long form
Yeah.
content. And I mentioned that I had reached out to Kyla Scanlon, who is a Gen Zer who is having a lot of success engaging younger generations around financial content on TikTok. You mentioned that she was actually on your TikTok
Yeah.
feed.
Yeah.
I am not a TikToker. But anyway, she accepted. So I'll be interviewing her, I think, next week.
Awesome.
So we'll be able to talk about that once you come back from your trip.
Perfect.
All right. Well, look, so obviously lots going on this week, especially, with the headlines around the Israel-Iran conflict. But I got a couple questions for you about that because you just wrote a piece recently, Lance, about that, and I want you to be able to, let everybody know
Sure.
whatever your most current thinking is on that. But right now, just looking at the markets, it looks like the AI trade is really back in the driver's seat.
Hmm.
Those companies are going gangbusters. Things related to the AI trade, like nuclear stocks, going
Hmm.
gangbusters, the Oklos of the world. Um, so is the bull back on? I mean, is this sort of the latest iteration of the Mag 7, where we're back where, the AI trade is fully in the driver's seat and the rest of the market's trying to follow?
Yeah, well, first of all, the AI trade has never been out of the driver's seat. It pauses every now and then, and of course, you get a lot of people that come on as like, "Oh, Nvidia's dead," or "There's gonna be a big crash in the AI market. The Mag 7's dead." And the bottom line is, yes, it'll pause every now and then because nothing can just, trees don't grow to the sky. But the AI trade is just getting started. We are a long way to go before we see what the ultimate maturity of the AI trade is going to look like. And it's not going to be just the companies involved in developing AI. It's going to be all the underlying supporting infrastructure stocks and energy stocks and all that goes along. And people are starting to wake up to that. But there's going to be some pauses along the way. For instance, talk about nuclear as a good example, and Oklo's been on a huge tear. But that's going to have a very big correction here at some point, not because it's a bad company, not because nuclear is not going to be a very important part of the power generation. It's because it takes 10 years to freaking build a nuclear power plant. The company makes no money. So, at some point, something's going to happen. They're going to report bigger losses than expected. Or some regulation change comes along that potentially delays the build out of a nuclear plant. I don't know what the answer is going to be, but something will happen and that stock will have a really big correction. And that's going to be an awesome buying opportunity to add that to your portfolio. So, again, I love these ideas when people come on, they start talking about the end of Nvidia or the end of the AI trade. I'm like, yes, put that message out there because I need that stuff to pull back so I can buy more of it. And we do that. April the 9th, AI's dead, Mag 7's over, and we were buying Palantir and Nvidia and others, right there on April the 7th, April the 8th. That's from an investing standpoint. Do that. Look for those opportunities to buy the Googles, the Microsofts, the Metas of the world, but buy them on dips. Don't buy them at all-time highs.
Okay. I had a similar story in the video I released right before this one was with
Yeah.
Rick Rule. We were talking about the future prospects of the energy sector, given the huge amount of electrification that needs to be done here at home in the US. You and I talked about
Yep.
this, might have been last week, Lance.
Yep.
And of course, that's not just a US thing, right? As the AI race really becomes at the forefront of national security now for the largest nations, there's a massive global race for electrons, right? For electrical production. So there's going to just be a ton of investment in the grid, in energy production worldwide. And, Rick just thinks this is going to be a fantastic investment theme
Mhm.
for like the next 20, 25 years. I mean, this is not a
Yeah.
short-lived thing. Now, to your point, nothing goes up in a straight line. And he actually thinks in the energy space, particularly like in oil and whatnot, um, there are some factors that may create some short-term uh, price weakness and whatnot, maybe even a recession thrown in
Mhm.
there. And if we have one in the next year or several years, he encourages long-term minded investors to look at that as a gift, right?
Yep.
As a way to get in these really big quality brands, the Exxon Mobil's, et cetera, at really attractive prices. And then if you're willing to kind of hold, for the long term, put this in your retirement account, put it in your kids' accounts, in 10, 15, 20 years, you're probably going to be really happy you did that.
Yeah. Well, that's just, but that comes, with us, we're long-term holders of companies that we like. And, we've owned Microsoft and Google for a very, very long time. AbbVie is another one we've owned for a very, very long time. And we're going to continue to hold that in the future, but we still manage that risk. When they get really overbought, we take some profits out of it, let stock pull back, we add back to it. And so, yeah, I mean, I would still apply some risk management to a
Absolutely.
long-term projection because things are going to look, things are going to happen. We're going to have, I don't know when. And this is the thing about, we've talked about this before. In order to make a prediction, you need three things. You need to say what's going to cause it, when's it going to happen, and what's the benefit of it, where to take advantage of it. And if you can't provide those three, shut the hell up because you're not
Mhm.
helping anybody. Um, but at some point, I don't know when, we're going to have a 30, 40, 50% correction for whatever reason it is. It'll be a credit related event of some sort. It'll be caused by some, financial issue that's cropped up in the market. Either the Fed has done, too late to the game or too early to the game, whatever it is. But something will happen and we will have another financial downturn of significance. And when that occurs, absolutely buy with both hands, have money available to do that. But again, you can't do that if you didn't sell something to start with. And this is why risk management is so important. If people that just ride the markets down, it's like, oh, I'm just buying and holding. I'm not going to worry about it. I'm in this for 30 years. That's great. But if we get into another 20-year period where markets go sideways, you've ruined your retirement. And so it's incredibly important to understand the 80/20 rule of investing is to really focus on avoiding those 20% tail ends of market cycles and capture that 80% in the middle, or avoid the 80% in the middle if it's a downturn.
Right. And you said the tail ends. I mean, obviously, I guess you want to avoid the downside tail
Yeah.
end, but you probably want to try to catch the upside tail
But yeah,
end.
yeah, I wouldn't. So if you look at kind of the 80/20 rule of investing, right? You want to sell the 20% at the top. And again, this is always the thing about investing is we're always worried about, if I get out now, I'm going to miss out on something, right?
Right.
Don't worry about that. If I'm a little bit early or a little bit late getting out at the top of a market, who cares? And that doesn't mean sell everything. It just means reduce your risk. And so
Right.
if we're at the peak of a market and we're starting to get signals of a more imminent downturn, then you start reducing your risk to try to avoid that 80% in the middle getting to the downside. And then once you get near a bottom, the mistake we make is like, well, I don't know if the bottom's here yet, so I'm not going to do anything. Don't worry about that. Just, when things get extremely oversold, like we were just back in April. I mean, you had allocation, positioning, and sentiment at levels we hadn't seen since the financial crisis, and we were only down 20% from the peak. And so that was such a great opportunity to put some capital to work. Yeah, the market could have gone a little bit lower, but it wasn't going to go a lot lower at that point. So yeah, you may be a little bit early, you might be a little bit late getting in, but those are much better risk reward opportunities to invest capital. And then if I can just get that 80% on the upside, I'm good.
Right. You're doing fine. Yeah.
I'm going to outperform the benchmark index by miles over the course of a 30-year period.
Yeah. And let me ask you this. I mean, I think you're sort of probably largely answering the question, but um, the one of the greatest benefits of investing is time, right? And being able
Mhm.
to use compound interest to your favor. and letting your winners run, right?
Hmm.
Um, and so if you have an advisory firm like yours, it's an entity, it's ageless, right? So the firm can really use time to its advantage, right?
Right.
Um, you can have these really long-term positions. Hey, we're not gonna sell out of this position. We may trim it and increase it as things ebb and flow, but we're gonna still be in it for the long run because you really believe this, right? But your book of business is made up of individuals and individuals who age out, right? Over the longer lifespan of the firm. So how do you balance those two?
Well, so first of all, so you're talking a little bit of two different things. So this is the Warren Buffett problem, right? So people go, I want to invest like Warren Buffett. You can't invest like Warren Buffett because when Warren Buffett buys Occidental Petroleum, he has a 100-year view on holding that stock with his company. His company, Berkshire Hathaway, will own that stock for, in his words, for 100 years because he believes in the fundamental foundation of the company. Now, reality is he can sell that anytime he wants, but that's the reality. And Warren Buffett is aging out. He's going to retire in the next year. Greg Abel's going to take over, and they're still going to own Occidental Petroleum. As a firm, we're not like that. We're not Warren Buffett. We don't manage a mutual fund. We don't manage a separately managed account. We don't manage an ETF. So when we're buying positions, our view is that we're going to own, as an example, we're going to own AbbVie for the next 25, 30 years because of what they do and where they're positioned. So as a new client comes in, we're going to buy that position for him when it makes sense. So we'll wait for him. He may come in cash and sit in cash for 3 months, waiting for AbbVie to pull back to a point that I can add to that position. So when we get to the point where I can add into that position, it gets added to his portfolio, and then we start managing that risk from there. So when it runs up, we reduce that risk. When it goes down, we buy some more. At some point he's going to say, okay, I need my money for retirement. That's okay, because when he starts taking money out, we're still managing those withdrawal structures relative to how it affects the performance of the portfolio. So he may need money out, but AbbVie, as an example, is doing really well. So we may sell some position that's not doing as well as it should be to give him whatever liquidity he needs at that point. But then we also focus on estate transfers, who's going to, where the money's going to go to after he dies. It's going to go to his kids. So we build relationships with the family, build relationships with the kids so that when something happens to the patriarchs of the house, the kids already know who the advisors are. They're already familiar with the strategy. And so it's an easy process just to keep that legacy going and allow the portfolio to continue to work.
Okay. Yeah, I find that really interesting, and maybe at some point we can spend a little time and go deeper into this.
Mhm.
Wasn't intending to do it in this conversation, but where you have sort of a general portfolio that you're running of, hey, these are all the companies we like, and we're holding them, and it's a good time to hold this one, it's a good time to trim this one, whatever, where you're kind of making the long-term decisions, but then you have to make the custom decisions in each customer's account based upon their own particular life needs and life stages.
Right.
Yeah.
And by the way, if this podcast is not sponsored by Chick-fil-A, my wife just happened to bring me some tea from Chick-fil-A this morning. So,
Oh my God, I can't believe it. You're such a clean liver, Lance. I'm surprised to
well, no,
see fast food in your house.
it's unsweetened iced tea with no ice. So, it's still clean. I'm all good. Just it's iced tea. It's iced tea
Okay.
with no ice. So,
All right. Well, look, anything else to say about the AI trade before we move on?
well, no, I mean, there's so much to talk about. One of the things that we're focusing on heavily right now is what's called behind the meter. In fact, Michael Leibowitz, who you'll interview, the week of the 4th, whenever you do that, that'll be a good topic for y'all to discuss. He's writing a two-part article on what's called behind the meter. And one of the big focuses that we're focusing on right now in our portfolio is natural gas, because again, the problem with Oklo and CCJ is the very long time horizon to get nuclear power plants up and operating. In the meantime, these AI data centers are getting built, and they're getting built sitting on top of natural gas pipelines because they can directly connect to the natural gas feed without having to go through the electricity grid to get access to power the data center. So there's going to be a really big opportunity in natural gas while we're waiting for that nuclear power to really come to fruition in the future. So, but that'll be a good discussion for y'all to have that week, because again, he's got a two-part article coming up on that.
Okay. Yeah, I'll go deep into this with Michael, but it seems that the trend here is that corporations, big corporations,
Mhm.
are increasingly looking not to get electricity from the national grid, but they're
Mhm.
looking to get their own power directly, right?
Well,
So I get,
yeah, the grid is outdated. The electricity grid, we need probably $1 trillion invested in the US national grid to upgrade it. It's simply the electricity grid in the United States is not capable of delivering the power generation needs that is going to be required by AI. So there's going to have to be a massive, at some point,
right? Or as Texas shows, not even able to deliver the power we sometimes need during storms.
California the same way. Y'all got brownouts. So, but the same issues, yeah. Um, but at some point, the government is going to have to come to the realization that they're going to have to go into a private-public relationship with utility companies to rebuild the power grid. And that's going to be a massive infrastructure requirement. And again, when you start talking about trillion and a half, $2 trillion to redo the entire power grid across the United States, that's going to be roughly $6 to $7 trillion worth of economic activity. And it's going to be great for the economy.
Yeah,
And so the sooner
that's
we can get to
exactly
it, yeah.
what Rick and I were talking about. But to my question,
Mhm.
folks, I've reached out to a couple of other energy experts to try to delve into this opportunity more. So hopefully we'll have some more, videos on this coming soon. Um, but when you say private-public partnership, I mean, I understand that that's probably highly going to be likely. But will we increasingly have companies that don't plug into the grid? They just like, I mean, potentially even Google might own some SMRs, right? Like
Mhm.
literally you have the reactor that's just powering, Microsoft's AI needs or whatever energy needs. So will
It'll
these be totally separate from the national grid?
No, that'll be part of it because again, you still have to provide the connectivity. And what I mean by private-public partnership is that the government only has two responsibilities. The government's gotten way off track of what its responsibilities are, over the last 50 years. But the government only has two responsibilities, which is national security and infrastructure. And when you start talking about utilities and power grids, et cetera, a big chunk of that is the government's responsibility. But so again, there's going to be the government's going to have to pony up a good bit of capital for that. But what I can kind of envision at some point is that this will be a relationship between utility companies and the government. The government will provide funding. The utility companies will provide all the labor, et cetera, needed to build out this power grid. Um, but it's going to be a very intensive project, which has a lot of great benefits. But again, at the end of the day, and again, I could be totally wrong, but I don't see Google getting into the power generation business. It's not their business, and it requires a totally different set of skills to do that. And they may. I mean, they could go out and acquire. Maybe they go out and they buy Oklo at some point, right? We're
Yeah.
going to need 50 nuclear power reactors. We're just going to go buy the company. It's very possible that happens. But again, probably in theory, because of all the requirements on a national security basis for that utility infrastructure, I kind of foresee it being more of a government project combined with utility companies building that structure out and then delivering the power to the actual end users.
End user. Yeah. So what I find interesting about this, and it's probably pretty clear that I'm still learning here.
Yeah.
So, some of these questions might be naive, but uh yeah, I don't necessarily know if, I mean, maybe someday they will, right? Own Oklo or own their own,
Yeah.
energy producers. But so one of the things that nuclear, the way the nuclear sector differs from other sectors of the energy space, at least right now, is um, this is what Rick was explaining. If you are buying oil or natural gas or whatever, you have no control over what the spot price is going to be in a week or a month or a year, right?
Mhm.
Where right now with nuclear, companies are buying, they're locking in energy rates for like decades right
Yeah.
now. And so, the Oklos of the world might build a reactor, and 100% of the output of that reactor might get bought by Google, right? So Google
Well,
doesn't necessarily own Oklo, but it is locking up
yeah.
the output from that producer for a long
Well,
period of time.
yeah, no, and you could think about it this way, right? What the future would look like is that let's say Google, Meta, Microsoft, they build an AI data center. Well, in that data center, is a nuclear reactor that's solely providing the power for that data center. I mean, think about it, right? We already have nuclear powered submarines,
Right.
right? The nuclear reactor is on the submarine.
Yeah.
It can go for an indefinite period of time, based on
It's an aquatic SMR. Yeah.
it is. And the only reason they have to dock is to refuel food, supply oxygen, those type of things. I mean, other than that, the power's there. So, the future, right, is probably going to be for micro reactors at some point, and whether that's Oklo or some other company that comes along, will figure out a way to build some type of nuclear reactor that's cold fusion, whatever, and they can just, say, I'm going to build a data center. It's going to have its own nuclear power plant. Done. Um, you know, what the future holds is going to be is the unknown part, but it's very exciting as to because there's just a million possibilities of how this can all turn out.
Right, exactly. And I guess where the questions I have in my brain that I don't have answers to right now is uh, how much of this will be private only,
Mhm.
right? Where you have these big deep-pocketed corporations that are probably building, the best of the best, but keeping it all to themselves. What will the government be building out in this new rebuild of the national grid?
Mhm.
And how and when may the two interplay with each other? So, for example, we're talking about nuclear energy, but the same thing can happen with natural gas and
Mhm.
other forms of energy production. But let's say you have an SMR, a small nuclear reactor. Um, Maybe it's powering your data centers just fine, but it still has additional productive capacity. So that will probably plug into the national grid and they'll make some money off of that. And
Mhm.
everybody will be happy because it's increasing our energy production and it'll probably be cheaper energy because it's the excess energy that they have. So
Right.
there's just going to be, I think a lot of really interesting ways that this could play together. It's so early, I don't fully understand this. And hopefully, if any folks are listening to this and are interested by this, we'll have some future experts on, like I mentioned, who can kind of clarify for this for us. But to Rick's point, and I think your point, Lance, probably opportunities galore for the savvy long-term investor in this story.
Yeah. And again, there's so many headlines coming out about, AI, the Mag 7, blah, blah, blah. And, don't sleep on what's happening underneath the surface because it's not just the generation of the AI and what we're doing with AI is absolutely incredible. Just, I guess, just it amazes me what AI can do. We're hiring a new CTO for our company. And he took one of our hour-long podcasts last week and in 5 minutes fed the podcast into artificial intelligence and it generated a 30 template slide deck encapsulating the entire show, all the bullet points, everything, which made a great pitch deck for our advisors to use with prospects and clients, right? And it took like literally 5 minutes. Normally, to do something like that historically would have required hours of manpower. What's the speed at which things are changing in the economy because of AI, the productivity boost, et cetera, and across all fields, not just finance, but medical, legal. Just the other day, I needed to have a contract done. I'm making an investment with a family friend, which I never do, by the way, but there's a special situation around this one. But I plugged in my parameters for my contract that I needed into ChatGPT, and I had a full legal document in like 15 seconds. I just go back and review it. So, I just eliminated the need for a paralegal to generate contracts. So there's good sides to what AI is going to bring. There's also some dark sides that's going to come out of this. I mean, a lot of job loss is going to be, an issue, but it's way too early to be calling this the peak of AI. This is really just the start of it.
Yeah, and I'm a little cautious to ask this question just because there's so many lovers and haters here.
Yeah.
Um, but I have reached out to Tesla, and I've asked to see if they might make somebody available on their Optimus team
Mhm.
to come on for a discussion. Another area I have some growing interest in, but very little real practical knowledge about. So Optimus is essentially their humanoid robot division.
Yep.
And if you listen to Elon and Tesla, they basically say that it's coming by the end of this year,
Yep.
when they'll start, shipping the first of these humanoid robots. Um, and Elon, who talks a big game, obviously, says, "Hey, who's not going to want a robot buddy in the future?" And when you hear their ideas for the applications of it in our lives, if it were cost effective enough, yeah, sure, it'd probably be like the iPhone. In fact, the robot might actually become your iPhone, right? Where it's giving you whatever information you want. You don't have to scroll. You just ask your robot buddy, for the answer or to project, whatever visual you want to see on the screen in front of his face. All right, look, so perfect. All right, and
Yep.
folks, I didn't know that Lance had this thing here. But let me just make this point and then I'll let you run, Lance.
Yep.
The way I'm increasingly thinking about Tesla or yeah, Tesla is X has one of the uh, most sophisticated AI out there, software out there, right? With Grok.
Hmm.
I think the company is called XAI, that is in Musk's umbrella of companies. So that's laser focused on, competing with ChatGPT and Claude and Gemini and all the other AI models that are out there. But that's about like how smart can we make AI, right?
Hmm.
Increasingly, I think of Tesla as the company that says, okay, how do we manifest AI in the real world? Like, how does it control things? And Tesla, if you think about it, is essentially a software controlled car, especially as they're getting into the robo-taxi space and whatnot. And increasingly, that's going to be all AI.
Hmm.
All right, you don't want a vehicle, you want something that's more humanoid. Okay, great. Well, that's Optimus. They very well in the future may make other things that we don't even know what they look like yet, but they're things that just the world would require. I don't know, a moon lander, a little surgical device. I'm just making these things up,
Hmm.
but like physical, real world things that AI will power. And if that's really true, then it does begin to kind of the people who a long time ago were like, you don't get Tesla. It's not a car company. It's a software company. It's going to be a whole bunch of other things. I got to start to get that more. It's like, oh, if it brings to life anything that's AI powered, like that's a much bigger
Yep.
market opportunity than just cars on the road.
Yeah. And the slide that I popped up about what humanoids will do in the future, I posted that slide on Thursday on X, and you know, the article behind that's talking about by 2050, that's just 25 years from now, there'll actually be more robots than humans living in the United States. And now they all won't be Optimus robots.
Is that because we want them so badly, or is that because they've killed
No,
us all off? It's
no,
only
no,
like 10 humans
exactly.
left.
Yeah, there's no humans left. They're all no, but a big chunk of those. Then in this article, they're going through all the issues, right? It's a really good article, but they're saying that a lot of these robots won't be, humanoid robots walking around. That'll be there'll be a small chunk of those that are, living and operating within households and those type of things. But a lot of them are going to be inside manufacturing plants. It'll be, kind of a fixed station robot that's doing spot welding or whatever, building cars. We have those now. They'll just become better in the future. So a big chunk of these robots will be in manufacturing, in manual labor jobs, warehousing, sorting, internal logistics, carrying stuff around. You think about just think about Amazon as an example, right? And their big warehouse. They have all these, massive warehouses of stuff that right now you've got humans walking around trying to, locate all these boxes and get them
Yeah.
onto the trucks to get them shipped and,
Right.
stuff like that.
They,
Well,
they and they do have a ton of robots too.
they
They
do.
haven't been AI powered in the past, but they will
Right.
be in the future.
They
Yeah.
will be in the future. And but again, when I have humans moving heavy objects, I'm exposed to injuries and compensation requirements and workers' comp and those type of issues. Well, I don't have that with the robot, and they
Right.
can move much heavier objects. They can move more objects at one time because of this. So a lot of these robots will be developed in the manufacturing space to start with. Services. Already you go to like a McDonald's, there's nobody at a McDonald's anymore. You order your own your own food, and they're going to have, eventually there'll be automatic burger flippers in the back that will make the burgers. Go to Starbucks, it'll be robots, making your coffee and bringing your coffee to the counter. So anything that is a very simplistic service or manufacturing job, that'll get replaced by robots first. And then it's going to start moving its way up into white collar jobs, right? So, legal, medical, those type of things, more and more of that as more confidence comes into the ability of robots and artificial intelligence. Again, I don't think a lot of people want heart surgery by a robot just yet, but we'll build confidence in that in the future. And so a lot of those jobs will become under threat as well. But again, eventually, yes, the cost of robots will come down, and you'll have a robot in your house that's doing the cleaning, washing the dishes, cooking your food, vacuuming the house, taking out the
Right.
trash, walking the dog,
Right.
the robot
Taking
will
care
do
of your
that for you.
kid, babysitting your kids,
Absolutely.
being the orderly for your
Yeah.
aged parent,
Yeah.
who's living in the house. No, and so look, it's increasingly, it's increasingly becoming clear that the path to the Jetsons future
Hmm.
is really possible. And it's building steam. And I just want to underscore two things. One, technology moves at an exponential rate, right? It gets better faster. That's certainly true with AI and software. And so while this still sounds a bit futuristic, um, honestly, Lance, I don't think the software is going to be the limiting factor here. I think it's going to be the hardware. It's just going to be how fast can we actually like manufacture this stuff.
Yep.
Um, but to your point about jobs, which we've railed about a lot in the past, so I won't do it here at length. But I think that's, humans we don't think exponentially naturally. We're just not good at thinking that way. Um, and I do think that the job displacement is going to get here faster than society is ready for. And yes, the workers themselves are going to be unprepared, but I also think the lawmakers are going to get surprised by this, and
Yep.
it's going to end up creating issues that were just not well planned for, right?
Well, and
So,
the other thing I think about too is there is a not so for the average person, you think about it, like, so let's say you have a robot in your house that mows your yard, does the dishes, vacuums, etc. That takes care of everything, right, for the most part. Well, we already have a propensity to sit on the couch and just scroll on our phones all day anyway. I mean, we already know that in the data. The data also tells us that the average health of Americans are getting worse, not better. Obesity is becoming more of a problem, not less. And what's been the change of that is that, back in the 30s, 40s, 50s, you know, everything was we were doing all of our own manual labor, and there was a lot of work being done. And it's funny if were you and I talking about this, if look back at parents, if pictures of your parents, everybody's fairly slim and in
oh
shape.
yeah, no, we humans look like a
Yeah.
different species. Yeah,
Yeah, yeah. And so I can just kind of envision the future when we have these robots doing everything. It's kind of like the that movie Wall-E,
yeah.
where everybody's in just the electric cart floating around, just plastered to screens. That's the future I worry about, right?
Yeah, and I mean, I think if you just look at the trends, that's where things are trending. So unless we actively try to pick some different destination, I think that's kind of
Yeah.
where we are. Until, of course, the robots just realize they don't need us, and then it's going to be more like Terminator. Um,
Well,
okay,
let's hope we don't get there.
yeah. So look, this is a little Machiavellian. It reminds me of this New Yorker cartoon. I'll try to see if I can find it, but it's a guy sitting around like a campfire in a tattered suit. It's a dystopian future. This is clearly a former businessman, but his suit's like rags now and falling off him. And he's talking to these little children around the fire. And he's like, yes, we ultimately destroyed the world, but for a beautiful moment there, we created a lot of shareholder value, right? And that does kind of make me think of uh, this question, which is, hey, look, there's a lot of things that could come out of this that might actually take society a good while to really recover from, the job loss, the loss of
Mhm.
purpose, all that type of stuff.
Yep.
But like, are the Teslas of the world, are they are they undervalued given this potential here, their role in this potential future? This is the question I hesitated to ask because
Yeah.
there's so many Tesla haters and Tesla faithful out there. But could it still be really dramatically undervalued given this type of future we're talking about?
Yeah, the issue is going to be is, if you ask me today, you say, Lance, would you buy Tesla right here, right now, based on this future? And I'd be a little bit reticent to say yes, absolutely, because the valuation based on what they're currently doing is still very expensive. I mean, we're strictly talking about fundamentals here for just a moment. So just step back from everything. Let's talk about fundamentals. So from a fundamental basis, the stock is trading at a very expensive valuation, both on price to sales, price to earnings basis, even on a forward basis, still trading 106 times earnings.
Okay, but sorry, based on the current car business or based on the discounted cash flow of them
Well,
creating all
that's
these things we're talking
huge,
about?
but that's what I was about to tell you.
Okay,
So right now, that's based on the current business as it exists.
okay,
The what we don't know. So let's say that your thesis is I'm going to buy Tesla because of this future in SpaceX, Starlink, all these other things that they're the humanoid robots, etc. The risk you run in that is that these things are all siloed and created, and Starlink goes off and it's its own IPO, which is going to be. Starlink is already raising capital on its own. It will eventually spin out public. Starlink will be its own business.
Okay, but
So
just clear that that's not part of Tesla nor is
I
SpaceX,
understand,
right?
but
Okay.
when we're thinking about Elon, right, we're talking about all the cool stuff he's doing,
Yep.
right? And the building out of Optimus and all this may very well wind up getting, spun off. So you get maybe you'll get some benefit of it in Tesla, but the real benefits are going to be in other things that he's potentially developing. So my point, what I'm trying to make is that fundamentally, it's very difficult to buy it right now because we haven't really seen any positive impact from these other businesses that he's doing affecting back into the cash flows of Tesla. Now, if you begin to see that occur and we begin to see more development in that area, then yeah, I mean, there's going to be a point to where you can make a fundamental case that Tesla is deeply undervalued relative to its potential. That's just not there yet. And I'm not saying it's not coming, but you still suffer the risk that again, if people were buying Tesla back near 500 just a couple of months ago, and the stock's lost about 50% of its value now, or 40% of its value. So again, you took a kind of it's easy to get caught up in these hypes for the moment, but at the end of the day, fundamentals are on when you're talking about long-term holding periods, 10, 15, 20, 30 years of holding period, it's all about fundamentals. Psychology will fade. This is the problem with Oklo we were talking about a second ago. It takes 10 years to build a nuclear reactor. That thing can go up and down by 50, 75%, multiple times before you get to the actual end result of where you're going to be. So this is, I have no problem if you want to own Tesla, no problem with it at all, like the company, et cetera. You just have to be careful of the risk you're taking on inside of your portfolio. I know people that have almost 100% of their money invested in Tesla. And if something goes wrong, just because of the markets and because of its impact and because of its positioning within the S&P, if something happens to the S&P for whatever reason, they stand to lose a dramatic amount of their personal wealth making a one-sided bet. As we always talk about, be careful with these one-sided bets because they can turn out horribly wrong.
No, absolutely true. And look, I'm sure we're going to get a lot of heavily opinionated comments in
Sure.
the comment section here. Um, and I'm being super transparent here. This is sort of territory that I'm still entering to really sort of try to understand here. But everything you said is true, and what I kind of hear from you, Lance, is especially on the sort of Optimus business, is sort of like, hey, wait, let's see how let's see how the launch goes. Let's see how much of this is real. Um, but I guess one of the questions I have around this, and I'm not trying to pump Tesla here by any stretch, um, but this concept of like bringing AI to life in the real world, it's an interesting trend. To me, it feels like the energy trend that we're talking about here, which is it's gonna happen, right? If we build all this AI capability, we're gonna need the things that AI is gonna control in the real world. And to me, I could be wrong, but it seems to me that there's a lot of economies of scale and stuff like that that you need to have to really succeed in this industry. And so it's it probably is a pretty big moat, right, for companies to get in there and get really good at this. And Tesla obviously seems to have a
Mhm.
really early start compared to a lot of other companies, I guess. I don't know. I don't know this space super well, so I'm having trouble like naming other companies that are well positioned to do this.
Yeah.
So if Tesla indeed kind of has, a good head start, it's got the economies of scale, it's got the capital to really invest in this big, it's got all the talent, at the company already going after this. Um, it seems like they're going to capture
Mhm.
some material chunk of that pie, right? And since
Absolutely.
that pie hasn't really manifested in the real world yet, this might be a time to say, yeah, I might own this thing for a couple of years and it still might not really go, it might not really realize the value of this new business yet. But at some point, if it does, there's going to be a material repricing.
Yeah, and again, that's that's what I'm saying is like, there's so many things that can happen in the future. Again, he could, take, and look, he's a very smart guy and he's going to want to capture the value of whatever that technology is. So let's just play hypothetically real quick. So let's say the future of the world is not electric vehicles the way that Tesla makes them.
Sure.
Some other type of car comes out and another car comes along and dominates that space.
Yep. The hydrogen powered hover car.
Sure,
Sure.
whatever you want. So, but inside of Tesla, which is now a potentially struggling business model, I've got this artificial intelligence data center that I'm building, Grok and everything behind Grok and
Hmm.
the Optimus robots. Well, if I leave that business tied to a failing business or at least a subdued business, because there's Tesla becomes a car company. Car companies in general don't trade at very high valuations. If everybody goes to electric cars, everything's going to start trading on an equal basis. So to unlock that value, I'm going to spin those companies off. Well, I'm holding Tesla. I don't get really the value of that spinoff as much as I would as if I just bought the spinoff itself. So in a lot of cases, my point is that sometimes it's better just to wait for the story to develop and then buy that company, because a lot of the times the bets that we make today don't turn out to be the case. Another company comes along. The one thing about technology and Moore's law is that things are developing so very rapidly that you might wake up in a month or two or six and all the stuff that Tesla was developing is now obsolete because something else came to market, and now Microsoft just rolled out this new whatever it is quantum chip, and that's the new thing. That's the problem with technology, and Moore's laws in particular, is the speed of development may make a current investment thesis obsolete. Sometimes it's better just to wait until it's a clear entry point into position. Again, I've got nothing against Tesla at all, one way or the other. I don't own it right now because it's lagging. So I don't want to own it right now. There may very well be a point that I want to own Tesla in the portfolio for a couple of reasons. One, it's a heavy weighted position within the S&P. So if I want S&P performance, I need to own those positions that are capturing all the ETF inflows. So every time somebody throws money into an ETF, it goes into
Right.
Tesla. But at some point, like in April, this thing got really beaten up. It was a really good trading opportunity coming off those April lows. If you wanted to own it, that was a great entry point. That entry point's kind of behind you right now. And so you wait for the next opportunity to buy it.
Okay. All right. Well, look, we'll end up on here. The only other thing I'll add to your risk factors there too is that, yeah, not only are the technology risks and the commercial risks you talked about, but there's also the
Mhm.
risk of your founder pissing off the president and
It's a
all,
risk.
yeah, all of a
No,
sudden, it's company non grata out there.
yeah.
So we'll see. I do just want to make one cute little assessment. You talked about Moore's law there, which I think most people are familiar with, and I'm not remembering the exact time frame, but it basically talks about how computational power increases in a certain period of time. Every certain period of time, computational power doubles, I think, and the cost of it halves, something like that over time period. So it gets better and cheaper on a predictable rate. So I think I've told you about this class that I had at Stanford that was a crazy popular class to get into because the professor just had this ridiculous Rolodex, and you would get
Yep.
these, incredible surprise guest speakers. You would never know who it was going to be when you walked into class. I think I talked about how I walked in once and, Warren Buffett was just sitting there. But Gordon Moore came in, because Stanford's there in Palo Alto in the heart of Silicon Valley. And, he's the developer of Moore's Law. He was a co-founder of Intel. And one of the just nicest, most self-effacing guys. He was older at the time, but he just said, "Yeah, I was just literally." He's like, everybody credits me with this, incredible, law of technology that I came up with, and they think of me as some, super genius. He said, literally, I just got a sheet of graph paper, and I was just kind of, graphing out, the history of our computational power and costs. And I just kind of realized the trajectory was like this. So I just kind of extended it. And, and he was like, it was almost kind of like Jed Clampett shooting at the pheasant and the oil came out. He was like, I literally was just making the obvious connection here. And then the world treated me like I was the next Albert Einstein.
Yeah. Well, this is the actual graphic from his book, talking about Moore's Law. And so, it's amazing how fast that we're now developing stuff. And again, that speed is just going to continue to increase, over time. So again, the leap from artificial intelligence to humanoid robots, and then to whatever's after that is, by the time, and what's going to be amazing is that this is stuff I never thought I would see in my lifetime. And now it's a very real possibility that I'm going to see the stuff like, when you saw, Will Smith and I, Robot, and some of the movies we saw in the late 90s talking about the future of flying
Hmm.
cars and all this type of stuff. It's like, oh, we'll never see that in our lifetime. There's now a really big possibility we're going to see that, for us boomers and us, us, or very late Gen X's and early boomers. Um, we're going to see that, some of that actually come to fruition, and it's going to be absolutely amazing.
It is, and it's crazy. The things that you just mentioned, they're out there. I mean, there are
Yeah.
flying cars.
Yeah.
There are companies that make flying cars. I think the Olympics, the next Olympics in LA, I think it is, they're going to have flying taxis part of there. I mean, I'm
Mhm.
sure it's going to be a small number, and it's going to be more marketing gimmickry and stuff like that. But
Yep.
the technology literally exists, and there are companies that are trying to commercialize it. So,
Yep.
will it become commonplace in the next 10 years? Who knows? But
Yep.
to your point, Lance, like a lot of this stuff that yeah, we grew up with and thought, well, fun to dream in sci-fi land, but it'll never happen. Like it's coming. All right, Lance. Well, look, now I gotta pull us out of the future of tomorrow and bring us into the present of today here, for a couple reasons. Some things happened this week I want to get your feedback on, but also just clear disclosure to the audience. We've been having some technical problems as we've been filming today. Your internet's gone down, Lance. You're working on a backup solution right now. Maybe the technology heard us having this conversation, and it's just doing a power flex just to show us that it increasingly is going to be making us jump to its tune.
Yeah, no, well, this is the future. Right? When at some point the robot overlords will, dictate what we say and what we use.
All right. Well, look, I think I'm going to need to get my own thoughtful money SMR or flex capacitor or whatever, just so we have our own uninterruptible power source and
Exactly.
internet source
Exactly.
here. All right, but let's see. So a couple things happened this week. Definitely want to make sure I get your feedback on. First off, we had a FOMC
Mhm.
release. Jerome Powell, did a press conference. This one really was kind of dull, to be honest. Not really a lot of no real changes, not a lot of news. Um, I don't know. Did you take anything material away from either the minutes or the press conference or the
Yeah, so
release of the press
the press
conference?
the press conference more than anything else, he's making a mistake. And in fact, I've got an article that I'm writing for next Friday talking about the history of Fed mistakes. And the problem with the Federal Reserve is they got caught up in this whole transitory word issue with inflation. In reality, inflation has been very, very transitory. The inflation spike we had lasted a very short period. It's been reversing ever since the peak of money supply ran out. So, historically speaking, this has been a very short lived bout of inflation. It was indeed transitory, but everybody was expecting like inflation was going to go away like in overnight. You're going to have this 9% inflation and it was going to go away in like 2 months. And that was never going to be the case because of all that input of money coming in. So the Fed got themselves all tied up around this whole transitory issue and not wanting to be wrong again. And so now he's focused on tariffs are now inflationary, but there's been no evidence of inflation coming from tariffs. Companies are finding their way around tariffs by basically finding different drop ship points to buy products from that can basically make them non-tariffed or simply changing the coding of a product. So let's say that I'm going to buy a raincoat and raincoats are tariffed, but regular jackets aren't. So I just changed the coding from raincoat to jacket, and all of a sudden I avoid the tariff. So a lot of that's going on right now. And so the real impact of tariffs, as we've been saying for quite some time, is not going to come to fruition, but yet he's unwilling to cut rates here. At the same time, though, you've had three central banks cut rates on an
Hmm.
emergency basis over the last 24 hours. The Swiss central bank is at zero. They're back to NERP, basically. And you've seen the ECB rate cut rates 8 times as economic data is clearly slowing. We just got out this morning as we're speaking. We guys got the leading economic indicators out again negative, another negative 0.1 print. That's been consistently negative for quite some time. And in fact, the 6-month rate of change of leading economic indicators has turned lower again after a brief recovery. The Philly Fed index came in much weaker than expected. So we're still seeing the hard data continue to suggest the unemployment data in particular, jobless claims data and continuing claims data continues to kick up. And so he keeps talking about, hey, we're worried about this tariff inflation problem and the employment seems to be okay, but there's clear evidence employment slowing down. The trend is clearly negative. We've had big negative revisions to employment over the last 4 months. And so, he should have cut rates by 25 basis points at this point, because again, where the Fed funds rate is right now relative to where inflation is currently at 2.3%, you've got to basically, you're about 2% over where inflation is. He should be cutting rates to help stabilize a bit. But again, he's going to be late. By the time he realizes he has to cut rates, we're going to be back into having to cut at 50 basis points at a whack to try to offset much weaker economic data at some point in the future, most likely. And the tariff issue isn't going to be the problem that he thinks it is. But again, they've got themselves into the psychological trap of past mistakes, which was the transitory issue. But this isn't the first time. Remember, back in 2007, going into the financial crisis, Alan Greenspan was hiking, Ben Bernanke was hiking rates,
Bernanke.
going, hey, subprime's contained, it's no big deal, everything's fine. And it wasn't. Alan Greenspan in 1999 is hiking rates because he was worried about the inflationary boogeyman that was hiding in the bush because of technology and the dot-com boom. That turned out to be a bust as well. So you go all the way back into history, into the 1970s, it's been one Federal Reserve mistake after another of either waiting too long to cut rates or waiting too long to hike rates. Just like in 2020, the Fed should have been hiking rates in late 2020, early 2021, when all that stimulus hit the economy, right? That big surge in economic growth with no supply because the economy was shut down. They should have cut off.
Okay, hopefully I made that last edit seamlessly. We lost Lance again there in the middle of that answer. But Lance, so it sounds like you think it's probable here that Powell may earn the moniker that President Trump is whacking him over the head with of too late Powell. So what's interesting about this is, the Fed is, as you said, Lance, right? I mean, it's always been criticized as being too late. That it conducts policy by looking in the rearview mirror, right? Now, what was interesting about I found interesting about the press conference is that a lot of the reporters were bringing up a lot of these issues of softening hard data, and Powell at one point said, hey, if I was just looking at the data alone, yes, we should cut. But I got to be forward looking. I kind of lost count of the number of times he said forward looking in his answers. And to your point, he was talking about tariffs. And he was just saying, like, look, we just don't know what the impact of tariffs is going to be. We're afraid it's going to be inflationary. So we want to wait and see. We want to just take our time, see what's going to manifest, and then we'll make our decisions. And, classic Fed speak. If we realize we should have moved earlier, well, we can correct that really quickly, right?
Well, and again, that's my point about Alan Greenspan in 1999. He was super worried about this inflation boogeyman. He was looking forward. I'm really worried about this inflation spike we're going to get from the whole dot-com, kind of boom that's going on. And so he was hiking rates right into 2000. And of course, the inflation spike never occurred because you had the dot-com crash. So, the problem with being forward looking is that he's still forward looking, but he's looking backwards at something that's already occurred, expecting an outcome that nobody has any idea of. And again, the thing about tariffs in particular, and this is the one thing everybody looks at tariffs as a coin, which is there's two sides to it. Either no tariff, no tax, or tariff, there's a tax. But what everybody forgets, and particularly economists are really bad about this, is they forget about consumer choice. I can either delay a purchase, not purchase anything at all, or buy something different.
Right.
And that's what consumers are doing. And businesses are smart. They're going to find a way around tariffs. If I can't pass that cost on to consumers, that impacts my profit margin. So and we're seeing this in the data already, the CPI PPI spread already tells us that businesses are having to eat these tariffs that are coming in.
Right. Which, by the
But
way,
they're
pat
going to
myself on the
find
back. I did mention that last week, but go ahead. Yeah.
exactly. No, that's right. And we've talked about this before. But businesses are going to find their way around tariffs. I'll move my purchases somewhere else. I'll use a different company to purchase that can avoid the tariff. I'll produce a different product that's not tariff, or I'll reclassify it into something that's not tariff. And we're going to see a lot of that going on. So, tariffs historically are disinflationary, not inflationary.
Right. And we've talked about that, and so I don't want to
Yep.
totally rehash it here, but so I
Yep.
was having this discussion with Axel Merck in our real-time live stream following the
Mhm.
conference, the press conference. And I'd be curious to get your thoughts on this question I asked Axel, which is, there's already debate on really how quote unquote inflationary tariffs are going to be. You have argued for a long time, Lance, they're probably not going to be inflationary. In fact, they may be disinflationary, as you just said, right? But let's assume for a moment that prices do rise because of tariffs, right? That's still, in most cases, going to be more of a price shock, like a one-time price shock, as
Mhm.
opposed to a sustained,
Mhm.
upward inflationary pressure, right? So the market will equilibrate in theory once you have that price shock, right? People will determine
That's
if
right.
I'm going to buy as much of that same product or if I'm going to do something else going forward, right? So it's a one-time event where a lot of the other concerns that you mentioned about the slowing economy, the weakening jobs market, et cetera, those are trends, right? And so if I'm weighing my monetary policy options, I would think that I would give more weight to the trends than to a one-time event, right?
Thank you.
Yeah. So
Thank you.
why is he not?
Look, I can't. I don't know what's going on in his mind. I mean, I am sure that part of this is simply that he doesn't like Trump. That's evident. Of course, they've been fighting for a while. And, I'm sure part of this decision-making process is, well, if I cut here, it looks like I just caved to the president. So now I
Right.
appear to be politicized, right? Look, I'm not saying that's the case. I don't know. But I'm sure that's a factor that weighs in here somewhere. But I mean, he may honestly feel like that he's doing the right thing here by looking at tariffs. But I think it's such a critical point what you're making is that consumers become normalized to a price change. Think about eggs as an example, right? Eggs went up dramatically in price. Now they've come down about 50%. They're still twice as high as they were a couple of years ago, but we're okay paying that because, $4 a dozen is cheaper than $6 a dozen. So we feel better about that price, even though it's $2 more than we were paying a couple of years ago for a dozen. So as consumers, we become normalized higher prices. So if there's a tariff on something, and let's say the price of a raincoat goes up 20%, you're right. It's a one-time price shock. If the price of that raincoat is the same next year as it is today, that's 0% inflation, even with the tariff. So to your point, exactly right. This is a one-time impact. Consumers will either make a conscious decision to change it, buy something different, not buy it at all, whatever. And in a year, it won't matter anymore. But to your point, the more important facet of all this is paying attention to what's happening economically. That's more disinflationary than it is inflationary nature. Now, having said all that, my newsletter for this weekend is talking about oil prices. We've seen a decent uptick in oil prices over the last couple of weeks because of Iran, Israel, this whole debate that's going on. That's going to feed into the CPI report. There's a very high
Sure.
correlation between CPI and oil prices because oil prices feeds through everything. So the next inflate we've had four inflation reports in a row come in weaker than expected. That is one of the longest stretches on record of economist expectations being missed, which means that in the next report, economists are going to drop their expectations on a hotter inflation print. With oil prices now, it's very likely that they're going to estimate a 0.1% increase in inflation. It's going to come in at 0.3, 0.2, whatever. It'll be hotter than expectations. Everybody's like, oh, it's tariffs showing up. No, it's oil prices. But again, it'll the headline du jour and the vindication for the Fed will be, oh, tariffs finally showed up in the data. See, there it is. No, it's oil prices showing up in the data.
Yeah, super interesting. All right, well, look, on this, we'll continue to wait and see, just to connect a few dots. Lance, you think that tariffs are going to have a much more muted impact than most people think right now. You think that, well, correct me if I'm wrong, but I believe you think that the risks are more to the downside in terms of disinflation and slowing economic growth from here, not runaway inflation,
Right.
or even sustained
Well, and
inflation.
Yeah, well, inflation is a byproduct of supply and demand in the economy. So you can't have inflation if supply and demand is slowing down. And that's what the economic data tells us, both in the hard data as well as the soft data.
Right. And for these reasons, though, this is why you think bond yields will start coming down again.
Yeah,
Yeah.
eventually, yeah. It'll
Yeah.
it'll it'll track the economy, yeah.
Okay. All right. Well, look, I want to get to the TA on the stock market right now, just because I'm very distrustful of this latest internet connection that we have, and I want to make sure that we get to that real quick before we
Yes.
potentially have to wrap this up early. Um, so the markets are. They're still trying to figure out which way they want to go here. Obviously, they got spooked with the outbreak of hostilities between Israel and Iran. We seem to be in this wait and see period now. It seems to be all about what the president's going to decide to do, right? Whether America gets more involved or not. And Trump seems to be, as usual, keeping everybody guessing here. Beyond that, is the market telling us anything yet about trend? I see we're still comfortably below the wedge that we broke out of to the
Mhm.
downside here. So what is this
Yeah.
telling you? I guess we're maybe coming up on a important moment here where if we end up hitting that whatever the red moving average there, whether it acts as support or if we break through it, right?
Uh, so a couple of things. Last week we talked about this rising wedge pattern that we broke below. And that was really on this whole initial concern over Iran and Israel. So that's that first red candle 4 days ago, 5 days ago, over Iran and Israel. We tested that red line 20-day moving average. Very important. That's been the running trend ever since really the kind of that April bottom and this kind of the start of this very heated rally that we've had. So, again, the market really hasn't gone anywhere since May the 12th. We've just been consolidating, and that's actually very bullish, right? The market's just trading sideways. We're slowly working off some of that overbought condition. The momentum signal at the top is on a clear sell signal right now. So that suggests that, prices going higher is going to be challenged more than not. Doesn't mean they can't go higher, but it's going to be more challenging. And that's really been the case now for the really since May the 12th. So, for over a month, we've just been kind of traveling sideways, which again, that's bullish because it's slowly working off this imbalance of supply and demand. Now, you'll notice too the yellow shaded area in the background, that's the money flow kind of tracker. And that's been dropping fairly sharply over the last few days. So it suggests, again, as the market's unable to go anywhere, it's because buyers and sellers are becoming more balanced and there's not a big demand of buying like we saw previously. So that's not, so sellers are having a more difficult time finding somebody to buy at a higher price. So sellers are having to drop their price a bit here to find a buyer. So far they've been able to do it right around that 20-day moving average. We're seeing activity there. Um, One thing is today we're talking right now. It is the largest June OPEX expiration in history. We have $5.9 trillion worth of options expiring today, which means that they've got to be restruck. Positions have to be repositioned. So if I was long a call or long a put, whatever, I'm getting called away potentially in the underlying equity position. So I'm gonna have to repurchase that position or sell that position, whatever. So a lot of stuff happening on Friday. I would just discount entirely. This is not about Iran. It's not about Israel today. It's all about OPEX today. So however this market ends up today, I would just not pay attention too much to today, realize where we are. But I think the bigger issues is that we've got some downside here to roughly around 5,900-ish would be reasonable at that point. As we kind of get down 5,850, 5,900, you're going to be coming up on the 200-day moving average. That's probably going to be your next entry point to add exposure to your portfolio. Importantly, the 50-day moving average is very rapidly catching up. So we had that death cross back in March that everybody was terrified about. It's about to reverse back into a golden cross. So we're getting a lot of stuff set up here. If we can just get this market to cool off here just a bit, give us a bit of a pullback would be even better. But even just a continued consolidation here is just fine. Work off some of this overbought condition, then we can definitely get some more money put into the markets and increase our equity exposure.
Okay, so it sounds like you're kind of looking at this as a little bit of a windy patch in the market, but setting
Yeah.
up for it sounds like you're kind of excited about what will be on the other side of it.
Yeah. I mean, we've had a near 20% correction, and that happens only about one out of every 5 years historically in the markets. It doesn't happen, it's a 20% occurrence in the whole history of the market going back to 1900. It's very small. So, when you have these big 20% drawdowns like we have, is 19.2% peak to trough. That's a really good reset for the market. So again, if you've been waiting for an opportunity for this market to cool off a bit, you have a good entry point. April was it. Doesn't mean we're not going to have another five. I certainly expect sometime this summer, potentially July, August, September, October, we get another 5% correction. Could be as much as 10 at some point. That'll be another buying opportunity. So again, just look for these opportunities where things get off sides and gives you a good entry point. Now, I will say here, the risk reward isn't as good as it was in April, because in April, you take a look at your technical indicators, they were as oversold as we've seen since the financial crisis. Sentiment, fear and greed, that was as fearful as we've seen since the financial crisis for the most part. And we're right now in the middle. We're not really aggressively bullish. We're not aggressively overbought on technicals. So the herd is right now. So again, we're kind of adding exposure because we're in the middle of those ranges. But at some point this summer, I wouldn't be surprised to see another pullback where we really get some deep oversold, kind of fearful positioning for one reason or another, Israel, Iran, or something else occurs. And that'll be another really, really good buying opportunity. And we'll talk about it because we'll be talking about, look at sentiment. Sentiment here is now as fearful as it's been since April. This is a good opportunity to buy some stuff.
Okay. And that's an important point. I just want to reiterate because it's something
Yeah.
you've been saying all year, which is, continue to expect volatility to continue, right?
Yeah.
It doesn't seem like you expect that we're off to the races once
Oh no.
this little windy patch ends, that it's going to still be up and down for the rest of the year.
Yeah, we might end this year up. Don't hold me to this because nobody ever knows. But this market could end the year anywhere between 5,900 and 6,300, which would be just a little bit higher than all-time highs. But we could be we might make a little bit of gain this year. We might be up 5, 6, 7% for the year by the end of the year. That wouldn't be surprising at all. We could also be flat to slightly negative by the end of the year. So that wouldn't be surprising at all either. I think this is just, after two 20% plus years in a row, you need this digestion year to get stuff back on sides. There's a lot of stuff that's really, really offsides right now in the markets. Today's article on our Substack page at Lance Roberts and on our website is talking about the death of the dollar is greatly exaggerated. The dollar trade is extremely offsides. There is going to be a very strong rally in the dollar at some point. And so anything tied to the dollar that's been benefiting from a falling dollar is going to really get hurt. And you'll want it, so you'll want to sell those positions. Anything that benefits from a falling dollar, you'll want to start taking profits in and start looking to add exposure to things that are going to benefit from a strong dollar rally when it occurs. And so that's going to be something I think happens maybe later in the year. But there's so much offsides activity, particularly in the dollar and other areas of the market, that we're going to see a big reversal in the markets. There was a big emerging markets and international trade at the beginning of this year. We're starting to see that deteriorate a bit. I think that continues later into the year, and we see a rotation of fund flows back into U.S. equities. Um, but there's a lot of stuff that doesn't quite make sense right now in terms of the positioning structures. So I think we see that kind of calibrate, as we get later into the year. We'll see how that works out.
Okay. All right. Well, look, Lance, I got to tell you, I am not trusting this internet connection. So let's get to your trades to make sure
Yep.
those get out there. What trades, if any, have you guys made over the past week?
By the way, the internet connection's fine right now, so I think we're good. I seem to be back on hardwire. So we'll just hang with me though. I've got them both
Okay.
running. um, no trades this week. Again, we're holding a little bit of excess cash. The positions that we bought back in April are doing fine. We haven't really touched those at all. And again, we're kind of waiting for this consolidation process that we're in right now to work itself out. And then we've got a whole shopping list of stocks that we talked about on the show over the last couple of weeks, um, looking for those opportunities to add. Now, and again, this is important, by the way. It's important to make your shopping list of stuff that you want to buy. right? And so we've got our shopping list of companies that we want to add to our portfolio or add to that are already in our portfolio. And you don't have to wait for the market. So when we talk about the market, it's like, okay, the market's really oversold now or it's really overbought now. That doesn't necessarily mean the underlying stocks in the market are doing the same thing, right?
Right.
There may be positions in the market that you want to buy right now that are currently very oversold because they're tied to a short dollar play, whatever. Um, and again, as I was saying a second ago, think about stuff that benefits from a falling dollar versus a rising dollar, and think about that in your portfolio. And then, so there may be positions you want to buy now that have already had a big correction in your portfolio. And then maybe there's some other stuff again that you're waiting for a correction to occur, and that'll you'll have to wait on that one a bit. Just a good example, Visa. It's had a it's had a huge rally this year so far. It was doing great. April and May, it ran up to all-time highs. It's actually had a decent correction over the last couple of weeks. So I just picked this one out just because it was kind of something I was looking at earlier. But if you're thinking about adding something like Visa to your portfolio, you've had a decent correction here despite the market. It's actually had a fairly sizable correction. It's oversold on multiple bases. You got to be a little bit careful here. It's still on a sell signal. But this is setting up for a better entry point on a risk reward basis than the market itself. So again, be careful with market overviews versus specific stock overviews in regards to your portfolio, because the market may be very overbought, but there may be some really good opportunities and things that are temporarily out of favor for one reason or the other.
Yeah, well, I mean, this is what we've been talking about for a good long while now, which is that,
Mm,
years like this one and perhaps eras like the one we may be heading into
mm,
are much better suited to active investing. And active investing is the old school investing where you don't just buy the market or buy the sector and just hodl. You instead, you have to do your research and you have to separate the wheat from the chaff and, find the good companies, the diamonds in the rough, and then wait for the market to reprice them. So anyways, seems like
yep.
that's exactly what you're doing. And by the way, Lance, I've got your list from a
Absolutely.
few weeks ago. Just let me know if there are any material changes to it. The companies that I'd written down at least were Meta, BlackRock, Raytheon, Palantir, Google, Amazon, natural gas pipeline companies, and other infrastructure companies. Is that still pretty much the list?
Mhm. Yep, absolutely. And again, this is, those were specifically talking about the how the coming AI trade can solve our deficit debt problem because of
Hmm.
productive investment into the economy and the benefit from that. And those are the companies, those were kind of early look companies at things that are potentially going to benefit the most from this AI build out. But again, you got to be, just don't go out and buy those. You need to selectively, manage your entry
Right,
points and those type of things. Like for instance, Meta's way overbought right now. You got to
right.
wait for correction.
Well, I think it's why you shared the list with us, where you said we're not buying them right now, but we're waiting for
Yep,
valuations to get down into our target zone. Yeah.
that's correct. Yes.
Yeah.
And of course, when
Okay.
we buy them, we'll talk about them here. It's like, hey, this week we bought Meta for whatever reason, and it's now in our portfolio.
Okay. All right. Well, look, I think I am going to cut it short, given the connection and where we are in time. There are a number of things here that we'll get into next week, and we'll do a proper rant next week. In wrapping up here, folks, if you are just heartbroken to hear that Lance is going to be gone in a week and you don't know how you're going to make it through your week without your daily dose of Lance Roberts, please let him know that you wanted to come back as soon as possible by hitting that like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help in figuring out how to navigate your portfolio through the continued volatility of this year, maybe even think about how to position for some of these longer term opportunities that Lance and I have talked about. Highly recommend that most people watching this video get that guidance from a good professional financial advisor. And if you've got one who's already fulfilling that role for you, great, stick with them if they're good. But if you don't have one like that, or you'd just like to get a second opinion from one who meets that criteria, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the short form at thoughtfulmoney.com. These consultations are totally free. It only takes a couple seconds to fill out that form, and as soon as you do, the firms will be right in touch with you. Lance, my friend, I guess I got you for one more week, but then you're gone the week after that.
Yeah, I was gonna say. So if you really don't like me, don't come back next week because I'll still be here. But the week after, Mike Leibowitz will be here, so come then.
Okay. Well, look, I hope you're able to, get everything planned and taken care of before you leave, so you can really relax on the vacation and come back and have it not be too bad. Because as you and I know, more often than not, no good
Yeah.
vacation goes unpunished, right?
No, I've been spending this whole week. I've got articles written for the next 2 weeks, so they'll be, so there'll be plenty of material. Go to our Substack page at Lance Roberts or X. They'll all be posted there for you on our website as well, realinvestmentadvice.com. But I've got some really good articles coming up about the Fed, absolute versus relative returns, as well as why you shouldn't benchmark your portfolio. So some good stuff coming up over the next 2 weeks.
Great. All right. Well, can't wait to see him. Good luck finishing doing the double duty. We'll see you here next week. We'll give you a proper send off. But always great, my friend. Everybody
All right.
else, thanks so much for watching.